Welcome to Rich Economy. Credit quality was not an issue at all till last year. But with tariff uncertainty and now war, did the credit quality of Indian corporates show a wobble in the just ended second half of FY26? More important, will we definitely see some credit decline, that is decline in credit quality in the current year starting today? Joining me are rating heads of two of the largest rating agencies, CRISIL's Somashekar Veburi and ICRA's Ravichandran. Good morning, gentlemen. Thank you very much indeed for your time. First, the easier question, Mr. Somashekar, what was the performance in the second half itself? Was there a decline from Q1 or H1?
So we look at a metric called credit ratio, upgrades to downgrades. That came in at about 1.5 times in the second half. Yes, there was a moderation from the first half, about 2.17 times. And that was largely on account of the fact that we've seen a slight dip in our upgrade rate, a slight increase in our downgrade rate. And all of these are primarily on account of the fact that, there was an aftermath of the U.S. tariff tantrums which export-oriented companies had to deal.
So largely the number of downgrades were in the export exposed or U.S. export exposed sector?
That's right. And having said that, I mean, what I would also want to highlight is reaffirmation still accounted for a bulk of our almost 82% of reaffirmation. So it implies more of stability. Marginally, 1.5 still indicates we upgraded more number of companies compared to downgrades. It's a moderation from what we have seen in the first.
Got it. Well, actually, this is the first time I have seen the two rating agencies have a different view. Actually, ICRA is not seeing a fall in credit quality. What has been your first half, second half, your second half observation versus the first half, Mr. Ravichandran?
In our case, the credit ratio was 3.2 times in second half versus 2.8 times in the first half. Perhaps, the picture is somewhat skewed by the upgrades which happened in few sectors, especially in the financial services where we had to upgrade companies focused in the capital market play. There are a couple of groups where, they represented the entire value chain. So when we upgrade, we tend to upgrade several companies in the group because we take a consolidated view. So 2-3 groups have accounted for a lot of these upgrades. Secondly, in the real estate space, more importantly, commercial real estate space, again, there are certain large groups where, we upgraded because momentum has been fairly strong in the commercial real estate space. And also some of the SPVs which were, getting into the REITs mode. Since most of these REITs are AAA rated, because of this transition, also we saw a fair amount of upgrades. But otherwise, in the core sector where, we have been seeing the pain, if we were to exclude these two aberrations, then perhaps the ratio was somewhat lower compared to the first half. That's how I would summarize the momentum.
Okay, yeah, as I can see in textiles textiles you could clearly see. Even in power there has been a slight deterioration. Very slight, but there is a deterioration. But now for the more important question, gentlemen, the world is not so much worried about the quarter that was, but the quarter that will be. And Mr. Veburi, over there you seem pretty worried in terms of what might happen in the current quarter, the quarter starting today. Where are the pain points that you are expecting?
What we have done, Lata, in the uncertain times that we are living in, we carried out a stress test based on certain assumptions. And then we clearly laid out those assumptions. One is the fact that we expect the conflict, West Asia conflict, and the disruptions to last for about 4 to 5 months in total, which includes the month of March, which went by, and consequently in the higher prices on oil and crude and gas supplies, etc. So based on that, we looked at about 30 sectors which have, in our opinion, some degree of impact, direct or impact on account of this conflict, which account for about 65% of our overall rated debt. And of these 30 sectors, what our conclusion is that 23 out of these 30 sectors, we see a limited to no impact on account of the West Asia conflict, primarily because the balance sheets are fairly strong or they have the ability to pass on the impact of higher input prices or the logistics costs, or they have very limited dependence on gas. And that accounts for almost 90% of the overall rated debt that we have considered in our study. There are about 6 sectors, which we see some degree of moderately negative impact on the overall credit quality. These include airlines, these include specialty chemicals, flexible packaging, polyester textiles, diamond polishers, as well as auto component players. Again, mostly the issue is that there is likely to be an impact on their operating margins, given that they may not be able to fully pass on the impact of higher fuel prices. But it's still moderately negative kind of an impact because balance sheets still offer some degree of a respite. The one sector where we are seeing it will be quite negative is ceramics, on account of the fact that we are likely to see a revenue share of almost 1/3 and margin hit of almost. This is one of the more vulnerable sectors. But having said that, this accounts for less than 1% of the rated debt. Overall, our credit quality outlook for the corporates is still more of a stability, given that balance sheet strength is fairly strong. Median debt equity ratio is less than 0.5. Interest coverage ratio is upwards of 5 times. So I think it's more of a stability, but with a caution on account of the fact that we don't know how long the conflict will last and stabilization.
No, Mr. Veburi, I know that you all assess credit quality and not earnings, but willingly you are going to look at numbers. Would you say that we have to be prepared for a lower earnings growth, profit growth in the quarter starting today, April, May, June, compared to Q4 or compared to year ago Q1?
Our stress test that we've done is based on a scenario where probably the stabilization period will last for a quarter, maybe a month, a quarter to 4 months, and if that plays out, then clearly yes, you would see an impact on the earnings and the cash flows. Having said that, again, it is still a scenario, a lot of moving parts. Just yesterday we had seen more just from both the countries that there is a de-escalation possibility, and also what impact it has on the infrastructure, the oil and gas infrastructure in the Middle East is something which also needs to be.
We cannot enter that discussion because what is said today gets erased tomorrow. So we have to wait for lasting peace. Mr. Ravichandran, similar question to you. Can we assume with reasonable certainty that the best of credit quality is behind us and we may start seeing credit pressures on banks and NBFCs in the April, May, June quarter?
Yeah, I would agree with that assessment. For India, consumption has been one of the major driver of growth. So with the uncertainty around the recent events, fuel price increase, and a lot of SMEs have been impacted, so that has changed the sentiment in smaller towns, and to that extent, we believe there will be a second-order impact on consumption and also some of the sectors like real estate, etc. From that point of view, the lenders who are exposed to these sectors, to MSMEs or other vulnerable sectors like ceramics and so on and so forth. Even they may feel marginal uptick in the credit quality, credit pressures. So from that point of view, overall, I agree with the assessment that the credit ratio perhaps has peaked and it may moderate in the coming quarters.
Okay. Your thoughts, Mr. Veburi, on the financial sector itself. You all are forecasting 13% credit growth compared to about 14-15% as of March 16 that the Reserve Bank reported. Reserve Bank data showed. So credit quality, credit growth, deposit pressure, does it mean that the finance sector is going to see continued worries for at least the first half?
Clearly, from a growth perspective, a tad bit of a moderation, given that there is this conflict which is there, and hence a lot of private investments. You could see some degree of a wait and watch, which would be there. Having said that, the consumption, is something which is likely to persist, and hence the retail is something which is likely to. In terms of asset quality, I think we have seen for a fairly long period of time the NPAs were about 2.5% kind of a range, and we when we looked at the overall corporate side of the picture in terms of our ratings roundup, we are not seeing too much of a pressure. It's more of a outlook which is of stable but cautious kind of an outlook. So unless the conflict prolongs, for a very long period of time, if it is something which is going to be contained in a relatively shorter duration, I think we should be able to manage. The capitalization levels for both the banks and NBFCs also fairly...
No, that I don't think is in question. My point was only whether incrementally the delta is a red arrow down. That is the worry. It doesn't really mean that we are going to be in a crisis mode, but clearly there is a question mark over ability to raise deposits. And a very important point you make in the CRISIL note, that the wealth effect declines when the stock market is down, over the past 2 years, whether that would also have an impact on the extent of retail consumption. That's the time we have, but thank you very much, gentlemen. The second half, they are a bit divided, that credit quality has also already started showing some tremors according to CRISIL. ICRA still sees credit quality good, but in the quarter starting today, there are clearly going to be some impact. Nothing hugely worrisome, but the delta is clearly lower as far as credit quality is concerned. We wrap up on Bazaar on that note. Chartbusters coming up.